Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. This is going to be an important one simply because it affects you. The first thing I want to look at is what the Federal Reserve is doing and what they're not doing. I'm going to give you some insight there. The second thing I want to talk about is Russia and the US dollar, how they correlate, what's happening with Russia and Europe as well. The third thing is the economic slowdown that's taking place. Everybody needs to know what's happening, and I'll get into all of that and more. Here we have this. The Fed should brace for a hard landing. There's always this talk of a soft landing. The Federal Reserve is just going to increase rates at the perfect amount and make sure that they're a little bit ahead of the curve, and then they can stop that and the economy is just going to slowly glide down and then head up higher. Well, of course, this has never happened, but hey, this time is different. Jerome Powell has it wrong. The central bank was slow to recognize inflation risks and begin to tighten policy. This is going to always happen because they can't see using the rear view mirror, using these particular data points and suggest they know what's coming in the future. Nobody does. It would be a hard job even if this wasn't always choreographed. Fed's Williams sees sequence of steps to raise rates to neutral. New York Fed chief calls uncertainty extraordinarily high. Nobody knows what happens in these kinds of environments where you have inflation going up like crazy. And of course, they were telling us 2 years ago that this was transitory, this was temporary, it's only going to be a period of time, and you didn't have to worry because it would not be embedded. And then a year passed, and they were still trying to, longer than we expected, but don't worry, next month it's going to be okay. Now we're here today. And of course, this is affecting everybody. It's affecting some people are really benefiting from it, but a lot of people are not at all, and they're really getting hurt because the food prices are up, energy prices, and so on. Fed policy action should deliver a soft economic landing. You will hear this all the time, but remember, they can't deliver that. It's impossible because of the way they operate. Clearly, we need to get something more like normal or neutral, whatever that means. Do we need to get there immediately? No, we can do this in a sequence of steps. So they want to lift interest rates by either 0.25 or 0.5, a quarter or a half a percentage point at each of these meetings coming up, so that by the end of the year, they're over 1%, and it would start to give them a little bit of breathing room when the next recession hits. Remember, we've talked about this many times before, and there's some people who still won't recognize it, but they need a little bit of a cushion. Okay, if this was normal and this was all reality and everything, they would need a cushion. So the last time around, they were at lower than 2.5%. And of course, they brought that down to 0%. It happened extremely rapidly, not enough room there, but that's what they did. And that small range at least provided them with some ammunition, but today they have nothing. Okay, very little. So they're trying to get those interest rates up. There's no question that that's the direction we're moving. We need to get back to neutral. Exactly how quickly we do that will depend on the circumstances that we're facing. And I do think we have to be cognizant of watching the economy and how it evolves. So basically, we're not giving out any information now. Don't worry, we'll watch everything and it's all going to be okay. Nothing new from Williams. Anyway, Fed is whetting appetite for a half-point rate hike. ECB releases the minutes. Poland and Peru may raise rates. Australian and Indian decisions seen keeping policy on hold. We'll see what happens, of course. You look around the world. Generally, most central banks around the world have been increasing, particularly in 2022. I've shown you the whole world rates, centralbankrates.com, something to that effect. Here we have U.S. payrolls saying, hey, we got a good gain. Jobs numbers are up. So you got the jobs numbers up. You got the stock market that is up. It is what? S&P's probably 4%, close to its all-time high. So there is no threat here, according to the statistics that they're going to use. Markets up, jobs up, of course. Inflation's up. So why wouldn't they be increasing rates? I mean, clearly, there is no real good reason according to the stats, according to the data anyway. And that's what people need to be aware of, but they simply ignore. The rapid absorption of unemployed into the job market can mean that the Fed can hike rates steeply to combat inflation without raising unemployment, at least in the near term. So this is the reality of where we are at today, where they have that breathing room according to their data anyway. So you could see the central bank decisions coming around. We will see what these countries do. For Australia's sake, you look at this and you just got to think to yourself, with housing prices, just like Canada, just like other places, at these historic highs, they need to increase interest rates right now because it is going way, way too hot. And people who haven't got into the market are getting priced out. And of course, the higher these things get, the more stretched people are. You get a lot of fraud that happens with the paperwork, and then it ends up ruining a lot of people. Doesn't necessarily have to cascade into a major event, but you don't want to see this ever. It would be nice if it was a slow and steady rise, but to see the prices of homes go up 30% a year, this isn't a penny stock. This isn't, a high growth stock. We're talking about real estate. It's supposed to move much more slowly, but it isn't. Okay, they're just talking about the different central banks and what they plan on doing. We will see. They're talking about, we're going to get the deficits down. That's never going to happen. How do they get the deficits down in a world that we have today? I mean, it's just not possible when they have to pump up more stimulus. The Reserve Bank of India, which remains at the dovish end of the central bank spectrum, is also expected to hold. The Central Bank of Sri Lanka is meeting, South Korea, and so on. Okay, let's see what happens. You look at the euro area inflation rate jumping to 7.5%. How in the world does Europe ever get inflation? I mean, they've been struggling it for so long to get this. Now they have it, and it is devastating to say the least. We'll see what they do in response. Kathy Wood says the Fed hiking interest rates would be a mistake. Oh, that's right. Of course, it would be a mistake for the ARK funds. There's no doubt about it. The high growth stocks don't like higher inflation rates. This is what a lot of individuals, particularly retail investors, do not understand, is that if we enter an environment with not high interest rates, but higher interest rates than where we've been at, basically 0% for a long time, this would have a negative impact on these growth stocks, on tech stocks. Okay, so let's see. Of course, I'll give you the impact of this in incoming videos. Look at the Federal Reserve. I noticed there was not only people saying this, but there were videos being made about the fact that the central bank's balance sheet, the Fed, continues to increase. They are not decreasing their balance sheet. You got to understand what happens. Every week is different. And every week, there are certain things that they buy, the treasuries, mortgage-backed securities, they roll off at different times. So it's not perfect. It can't be exactly at, let's say, $9 trillion. And we're just going to keep it precisely at $9 trillion. It depends, okay? But you could see in the previous week, the numbers came out and essentially it went down a little bit, okay? I just want to make that clear for everybody. You can confirm that on the Fred website. You can also do this. Go to a search engine and type in H41 Fed. Okay, H41 Fed, and you will pull up the latest data right here. This is from March 31st. That's the latest information, and you can verify that for yourself. You see all of the different things. It just breaks down each and every thing that they do that's made public, and you can see that for yourself on here. Okay, you don't need to guess. You don't need to rely on some YouTuber. Don't believe in them. Okay. And then we move on to this. I just wanted to show you, number one, what's happening with Russia. And we'll get into some other stuff. So the IMF's managing director essentially said that what's happening with Russia right now, the restrictions, the sanctions, and so on, could encourage the emergence of small currency blocks based on trade between separate groups of countries, essentially doing away with the dollar on a limited scale. The dollar would remain the major global currency even in that landscape, but fragmentation, important word, fragmentation at a smaller level is certainly quite possible. We are already seeing that with some countries renegotiating the currency in which they get paid for trade. You look at this, you see it with China in particular, you're seeing it with Russia, you're seeing it with India and many other countries. This is taking place today and it is continuing to expand. And remember that word fragmentation. I'm going to try to be using that one many times. You have this, Gazprom has stopped deliveries of Russian gas to Germany via the Yamal-Europe pipeline, and today the volumes began to flow in the opposite direction. So let's keep an eye on this one. I want to watch it very, very closely. This could be impacting you, my friends, in Europe. So we'll see. Europe's risk exposure to Russian gas cutoff, and it breaks it down. So the darker the level of green here is the more exposure. The dark green Hungary is at 60. Okay, so that's the highest. It seems like that on the list, but you've got other countries like Austria that are high up there. Germany's high up there, and others. Never, ever, ever rely on one country for anything if you can help it. Let me tell you, we've learned that lesson over the past few years. Okay. Let's talk about the next aspects here. Big stuff happening, big developments today. This is just one that I've been covering. I said, hopefully it doesn't go all the way out, but it seems like we got there. Entire Shanghai placed under lockdown. Restrictions. We're going back into 2020 here. This means, number one, what's happening with the ports, what's happening with products trying to get out of China, what's going on locally, internally. This could create more havoc and concern. Markets are not going to price that in, let's be honest about that. But you have to look at this as an economic sense and what that means for you. So, like, Shanghai's port is perhaps the most important in the world. So much volume moving in and out. You shut it down, what's going to happen? I don't know all the details, but again, we'll see, okay? Over a third of Americans plan to spend their tax refund right away, mostly to pay bills. So this comes from CNBC, and I just wanted to show you this because it shows us where people are today. They are really struggling right now for some income. They are struggling for, how to pay their bills. Their disposable income continues to decline. The stimulus just isn't there like it was in 2020 and into 2021. And we see the effects of that directly in the economy today. This is just showing us the mortgage rates. As mortgage rates go up, this is specifically the 3-month change. And we haven't seen this since the 90s. Okay, huge change at that point. In a short order, and this is probably going to accelerate beyond that anyway. Connected in with this, soaring mortgage rates in U.S. dent demand for vacation homes. I thought it was interesting because it's not like personal residence where, if somebody needs the home, they're going to bite the bullet, they're going to do it, they're just going to go for it and overpay. That happens all the time. In this case here, vacation homes, they're going to get rid of their vacation homes first. Now, typically, a few years ago, I would have said, watch Florida. Florida vacation homes, that's the big one. Now it's less of an issue in Florida because of the demand. You got businesses moving there, you got people moving there in general, lower taxation and so on. So it's not quite the same as it was before. If you got any words on that, put in the description, put in the comments below, and don't forget to hit that thumbs up button to support the channel, okay? Want to thank you for that. And this right here just shows us the single family housing outperformed in Florida, including the coastal markets. You could see Florida is that black line. And then you look at Miami, which is just under that, Tampa, and then North Port, Sarasota, Bradenton. And all of that, of course, just shows us kind of an average of where it has been, over 40% for Florida in general. Unbelievable to see the growth, but also seeing it in businesses. When you look at retail, when you look at office space, unbelievable to say the least. And this is just showing us right now, really quickly, out of Real Investment Advice, percent of the 10 yield curves inverted. It's a very small number today. This will definitely go up over the next couple days, couple weeks, whatever it might be. It is at 10% today. Historically, a recession followed when 50% or more of the tracked yield curves inverted every time. And of course, we don't know, how the distance on that. In the previous video, which I will link to at the end of this one, I specifically noted something so important, so key. Most people are ignoring it, so check that other video if you haven't seen it already. But basically what we're looking at here is the timeline has been brought up by as much as 2 years on all the effects Okay, I covered it more in depth in that video, but looking at this right now, we can just see that we are in a state of concern because of individuals, because of what's happening with debt, because of the concerns with, what's going to happen with the supply chain. Countries are now saying, okay, we used to export that particular product. We're going to hold back on that. We're not going to do it because we don't know what's going to happen here. We got concern. And this, of course, all adds up. Big problems left, right, and center. If you stay on this channel, you're going to get to know what's going on, all right? I've got all kinds of solutions in a playlist called How to and Solutions. I covered it in my 2 books. We don't have to pay a thing. Check out the playlist, How to and Solutions, okay? Big stuff. If you appreciate the information, hit that thumbs up button and don't forget to subscribe because all of these videos coming at you every single day, keeping you up to date. All right, I'll check you out on the next one. See you later.